So you want to run a business, but you don't know what business to start or have an idea for a new product or service. Well, here's actually an area where I agree with many of the YouTube gurus. They say instead of starting a business, buy a business. Now, I'm biased. I work in private equity, so of course I think that's a good idea, but private equity isn't always accessible to everyone. So in today's video, I want to talk about how to use an SBA loan to purchase a business. Now, I'm not going to get into how big the loan is or what the interest rate is going to be. That's easily researchable on the internet and whatnot. What I'm going to talk about is what people don't tell you about getting an SBA loan and some of the challenges and pitfalls to watch out for. Stay tuned. I do have 15 years of experience working in and around M&A, private equity, and I've also bought a business using an SBA loan. Actually, worked on 2 SBA deals that ultimately closed. What I want to do here is talk about some of the learnings that I've had are probably not going to get unless you've actually been through the process yourself. SBA loan officers really are business development folks. SBA loans are so lucrative for lenders that they have teams of people that are out there trying to originate more SBA loans. When you talk to an SBA loan officer, a lot of what's going on is really them analyzing at a high level whether it checks all the boxes that their bank requires for a loan. What's the loan size? How much is the down payment? What do the historical financials look like? What's the structure of the transaction, et cetera, et cetera. Just remember that there are going to be certain things that the loan officer is looking for that are going to be very important that they might not tell you right out of the gate. I would say the first one is what debt service coverage ratio they are looking for. Debt service coverage ratio is really just how much cash flow you have to service the debt. The higher the number, the better. What I've seen is that a lot of SBA loan officers like at least a 1.5x debt service coverage ratio. So that's why I've always kind of targeted 1.5 to 1.75. But that's one example of an important criterion that a loan officer is probably not going to tell you about. The second area I'd like to talk about is whenever I was working with different SBA lenders trying to get these loans approved, it's very common that I would hear the SBA doesn't allow that. And I'd just be thinking to myself, well, that's weird because it sure sounds like from this other lender that the SBA does allow that. And so ultimately what I did is I started just going to the SBA SOP directly, which you can find through a Google search, and reference the specific sections that are talking about the topic that I was curious about. Through that research, what I found is that oftentimes what the bank will do is they will say it's the SBA allowing or disallowing something, and really it's a bank practice. Sometimes I'd talk to lenders and they say, well, no, you can't really do that. The SBA frowns upon that, et cetera, et cetera. That's not really the case. I mean, it's got to be, the seller note has to be structured a certain way, but it is absolutely allowed by the SBA. It just might or might not be pushed by the actual bank. That's a clear example of where it's not a SBA thing that's limiting it, it's the actual bank that you're working with that is limiting it. Presumably, as part of your negotiations and whatnot, you're going to negotiate a normal amount of working capital based off of historical practices is kept in the business. However, it probably is going to make sense to have a range, a working capital line of credit. We have working capital lines of credit in literally all of our businesses. So I would strongly encourage you actually to have that in place. Typically, whenever you're working with a senior lender, they're more than happy to place a working capital line alongside their senior note. However, a lot of SBA lenders are oftentimes different than that. In the first deal that we did, our SBA lender just said, listen, we don't want any of your deposits. We're not going to give you a working capital line. All we're doing is the SBA loan, and you're on your own for all this other stuff. So actually what we had to do is we had to go to another SBA lender and get our working capital line through that other SBA lender in order to have the working capital required to operate the business. It's not a terrible situation, but again, it's just something that you really need to think about and develop a plan for early on in the process so that you're not getting close to close and you go to your lender and say, okay, what are we doing for working capital? And they say, sorry, pal, you're on your own on that one. I mean, what I will tell you is that, it is a breeze. There are no covenants. I get a notice, once a year, tell me they need me to send my tax returns, financial statements, et cetera, et cetera. It is really a pretty easy process. So if you can stomach all the additional paperwork and the personal guarantee, then what I would tell you is that it really can be a very good option if you want to purchase a business. How does it make you feel about using an SBA loan to purchase a business? I know many people are going to say, oh, I can't do the personal guarantee. I can't do the personal guarantee. Well, unfortunately, we've looked at a lot of different loans, and whether it was SBA or conventional, you almost always have to put a personal guarantee on it. If the personal guarantee is that concerning and whatnot, is buying a business really for you? Let me know what you think. Have you purchased a business using an SBA loan? Do you have any experience with the program? Let me know. Love to hear from you. Social media is crazy. If you go on Facebook or Instagram, you see all these posts from your friends about vacation and new cars and all this really great stuff. And it makes you think that your life isn't so great, or you're not as successful as some of your friends, or many other bad thoughts. I'm sure if you're not a business owner yourself, you've talked to a business owner about how they sold their business, and man, that's another example of how great it can sound. However, it was probably an uncomfortable process. Stay tuned to listen what you can do to hopefully decrease that level of discomfort. For many business owners, whenever they sell their business, that's essentially the start of their retirement. The idea that you're not going to have any place to go come 8 o'clock on a Monday morning is something why selling a business can be uncomfortable. You have to prepare yourself that post-close, there is going to be change. If you're passing your business down to your son or daughter or a key manager or whatever, doesn't mean they're going to do things exactly the same. In terms of private equity, a big goal of private equity is to grow. Another big goal is to increase the sophistication of the business so that there are processes and procedures in place so that whenever the company grows, the company's actually able to handle that growth profitably. For a lot of folks, all that process and procedure talk feels like bureaucracy. Bureaucracy is anathema to what most entrepreneurs think about whenever they think about why they started the business, what got them excited about the business, what kept them excited about the business all these years. Of course, you're going to have to share company financials, but you're going to have to share company tax returns. The buyer is probably going to perform a background check on you, which even might include a credit check. Maybe that bothers you, maybe it doesn't. Perhaps even scarier is that at some point, they're going to want to talk to your employees. They're going to want to talk to your customers. They're going to want to talk to your suppliers. Now, granted, that comes very late in the process, but still, all those things are uncomfortable. I completely understand why a seller does not want the prospective buyer to talk to the employees, because what happens if the deal doesn't close? That creates a lot of strife and uncertainty for the employee base. Regardless, at some point, it's going to have to happen, so you really just need to prepare yourself for that eventuality. Who is your buyer? Are you going to get along with your buyer? How long is the process going to take? What's the buyer going to do with the business post-close? What are people going to think about me? But my experience tells me that many business owners get to the point in their careers, with their businesses where they know there are going to be certain events or economic conditions or changes with their customers that are going to throw them for a loop to some degree. However, they've been thrown that loop many times before. They know how to handle it. So whereas they have the experience in dealing with these other types of uncertainties, they don't have the experience dealing with these types of uncertainties. And for that reason, it can be a very uncomfortable process, which is what we're talking about here. The first is that I strongly encourage you to not start down this path if you're not going to be committed to the process. We work with numerous sellers that tell me they're ready and they want to move forward, and throughout the process, I just noticed some hesitation. Earlier in my career, I think I would have tried to convince that person that yes, this is the right move, and really try to persuade the seller that now is the time. I don't do that anymore because even though I might have been persuasive at that particular moment, once they get home or in a week or two, when I'm not staring across the table from them, then that persuasion doesn't really hold anymore and they decide maybe it's not right. The second key takeaway is that I strongly encourage you to simply learn more about selling your business. I've even written a book about how to sell your business to private equity. And in that book, there is a discussion about how to potentially increase the value. That's important, but the mindset and the preparation, I think, is even more important. And what I mean by that is start to look at this process from the eyes of your buyer. In doing that, think about what's going to be important for them, what you can do to make the process easier, to allow them to get to know you, to get to know the business, etc., so that there's at least a few parts of this process that are not quite as uncomfortable. Now, at 4Pillar, our role isn't to advise sellers on how to improve their business or what changes to make. However, I really like whenever I am talking to a business owner that has thought proactively about how to sell their business and what they want to achieve and this and that. That's part of the reason why I wrote this book, is not change your business so that it's attractive to private equity. It's being proactive about emphasizing the strengths of the company, letting the buyer understand those, while also being objective about some of the challenges that the company faces. I get it. It's going to be uncomfortable. It might even be something you dread. But remember the statistics. 20% of businesses fail after 2 years. 45% fail within the first 5 years. 65% fail within the first 10 years. And only 25% of businesses make it past 15 years. So through this trying times, just remember that the folks that are the most successful had to endure the toughest challenges. Enduring this challenge is the price that you have to pay for a level of success that most people will not achieve. So I don't know if you're the type that embraces the mindset of ignorance is bliss, but if so, I apologize for bursting the bubble. Feel free to hit that dislike button because even though it might hurt my feelings, it's not public and it's not gonna sway anybody else. However, I do hope that I've at least opened your eyes to the idea that the process of selling your business, while the end is probably going to be a great achievement, getting that final last mile, so to speak, is going to be a challenge, and it's just one more that you will have had to endure as a business owner. Imagine a world where a ragtag group of retail investors takes on Wall Street, causing a seismic shift in the financial landscape. This is the story of GameStop and Roaring Kitty, a saga that transcended the boundaries of traditional investing and became a symbol of a new financial era. In early 2021, a Reddit community known as r/Wall Street Bets turned the financial world upside down. They spotted an opportunity in GameStop, a struggling video game retailer, and decided to take on the big players, the hedge funds betting against the company's success. Leading the charge was a YouTuber and financial analyst named Keith Gill, better known as Roaring Kitty. His passionate analysis and charismatic online presence inspired thousands to join the movement, driving GameStop's stock price to unprecedented heights. But this wasn't just about making money. It was about sticking it to the big guys, the hedge funds, that seemed untouchable. It was a David versus Goliath battle, and for a brief moment, David won. The timeline of events is nothing short of remarkable. In January 2021, GameStop's stock price was languishing around $17 per share. Roaring Kitty's detailed analysis and optimistic outlook on GameStop's future started gaining traction on Reddit. By mid-January, more and more retail investors jumped on board, buying up shares and options. The stock began to climb, hitting $40, then $100. The frenzy reached its peak on January 28, when GameStop's stock price skyrocketed to an astonishing $483 per share. Even ignoring the craziness of meme stocks, there are still going to be periods of rapid stock growth or contraction from time to time that might or might not correspond to macroeconomic trends. What is the right strategy? Or perhaps that question is too narrow because it implies there is a single correct strategy to pursue. More broadly, what are the characteristics of a winning strategy? Warren Buffett, whom we all know, would suggest investing in index funds. Is that a path to prosperity? Stay tuned as I dive into topics such as random walks, tulip mania, and the efficient market hypothesis. First though, a disclaimer. What follows should not be considered investment advice. Please consult an investment advisor before making any investment decisions. My personal favorite book on investing is called A Random Walk Down Wall Street by Burton Malkiel. There are numerous concepts described in that book, but a few themes are most prevalent. First is that neither fundamental analysis nor technical analysis will outperform the market. According to Investopedia, fundamental analysis measures a security's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and industry conditions, to microeconomic factors like the effectiveness of the company's management. The end goal is to determine a number that an investor can compare with a security's current price to see whether the security is undervalued or overvalued by other investors. This video mostly discusses investing in public equities, for which most people believe there's at least some level of intrinsic value. However, take a look at cryptocurrencies. Some people believe the cryptocurrencies don't even have any level of intrinsic value. How would you value those? The other camp includes the technical analysts. Investopedia describes technical analysis as a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. Malkiel's position on this is that these types of analyses do not outperform the market because the performance of the market follows a random distribution, in other words, a random walk. One type of trading that will not be covered in this video is quantitative trading. Quant trading involves complex mathematical models, also high-frequency trading in certain strategies. The end result being that the average retail investor just doesn't really have access to that type of trading, and for that reason, we've decided to exclude it. Regardless of whether Malkiel is correct in his view that neither fundamental nor technical analysis will outperform the market, I think it is safe to agree with his position that human psychology decreases investing performance. I would like to spend a bit more time here because any investor, be it a professional or retail investor, will battle these challenges, and it will also be relevant to a later segment of this video. One of the factors of human psychology that will negatively impact investing performance is overconfidence. I'm sure we have all invested in a stock or had a gut feeling about a stock and it turned out great. This might lead some of us to overestimate our abilities. A logical next step would be to double down on our gut instincts, perhaps performing less analysis and/or taking more risk. On the flip side, if we lose money on an investment, a common response might be to blame the loss on outside factors, instead of trying to uncover the ineffectiveness within our trading decisions. Another challenge is biased judgments. The concept here is that we might think that we have control over certain situations even though the outcome is perfectly random. Now, the outcomes of sporting events are not random, but many of us have superstitions when it comes to our favorite team. One of the hometown heroes here in Kansas City is Patrick Mahomes. At one point, his wife mentioned that he has worn the same pair of underwear for every NFL game in which he has played. As quarterback, Mahomes has some amount of control over the game. I realize he doesn't really think that changing his undergarments will have an impact on the outcome of the game, but it highlights the very human desire to think that some of our actions will help lead to a desired outcome, even though those actions have no actual bearing on the outcome. Stay tuned to the channel for an entire video dedicated to the topic of cognitive biases in decision making. Third is herd mentality. which makes it hard to stand on the sidelines when an individual stock or the market as a whole is doing well. Herd mentality is a big factor in the incidence of asset bubbles and market meltdowns that follow. What is an asset bubble, though? The first widely accepted asset bubble was the Dutch tulip mania that occurred from 1634 to 1637. Nothing too complex here. Tulip bulbs became a hot commodity and prices skyrocketed. Some records indicate that folks were willing to pay 10 times the annual income of a skilled worker for one bulb. The bubble eventually burst, and even though it is not believed to have caused widespread economic distress, it is still noteworthy. More recent examples include the dot-com bubble of the late 90s and, some would argue, meme stocks such as GameStop or cryptocurrencies. It might seem as though herd mentality is another form of peer pressure where you might know you don't want to do something but go along with it because everyone else is. What is interesting, though, is that McLean shares certain studies that suggest our perceptions actually change. For example, a study was performed in which two lines were drawn, A and B. Line A is clearly longer than line B. There are a number of people who are portrayed as participants but are instead actors. They all say that line B is longer. The final person to offer an opinion is the only real study participant. In many studies, this person also says that line B is longer. In post-study interviews, the participant reiterates that he or she really thought that line B was longer. Fascinating. The fourth component of how human psychology affects our investment decisions is loss aversion. Let's play a game to understand this concept. I will flip a coin. Heads, you win $100. Tails, you lose $100. Would you play this game? Most people would say no. In fact, some studies have shown that the payout must grow to $250, with the potential loss still being $100, before people are willing to play. The expected payout is very positive, which indicates risk aversion, not risk neutrality. What is unclear to me, though, is how many times you are allowed to play the game. If you are, in fact, only allowed to play once, then absolutely put me in the loss-averse crowd, because I don't want to lose $100 after one coin flip. But if I could play many, many rounds, then I'm going to let the expected outcomes rule in my favor, and I would accept a much lower payout. If I could play 10, 20, 50 times, I'm going to come out ahead. Moving past the different types of analyses as well as human psychology, there is a term called the efficient market hypothesis that needs to be discussed. Proponents of this theory believe that a stock's price is reflective of all available information, and therefore, it is impossible to sell a stock for an inflated price or buy one that is undervalued. Let's just say I'm not a firm believer in that form of the efficient market theory, which is called the strong form. Here is a common anecdote used to discredit it. If you are walking down the street and see a $100 bill, then that bill must be fake if the strong form of the efficient market hypothesis is true. Why? If the bill were real, everyone would know about it at precisely the same time, and it would have been picked up already, or at least there would be others ready to pounce. I don't buy it. Malkiel's final proposition is that investors can beat the market by investing in index funds, bonds, real estate, and cash, the percentages of which depend on the investor's investment horizon and will change as the investment horizon becomes shorter. The reason that the asset allocation formula changes over time is because the volatility of the stock market is quite high for 1 year, but is much lower as the hold period lengthens. So it isn't just asset allocation that matters, investment horizon is critical too. This is great though. Everyday investors can beat the market with this strategy. What do we mean by that though? Instead of a market return of, let's say, 10 to 12%, we earn a return of 12 to 14%? Does that drastically change anything? Well, what does the math say? $1,000 invested today for 30 years, averaging 8% per year, would grow to $10,063. If all other parameters remain the same, but the average return were 10%, the sum would almost double, totaling almost $17,500. That is meaningful, right? My argument would be that no, it does not meaningfully change anything. Am I really trying to say that an additional $7 for every $1 invested is not meaningful to me? No, that's not what I'm saying. What I'm saying really is that I'm asking and answering the question in a different context. Does beating the market allow me to fundamentally change how I approach my career, my life in general? That is the precise question to which I would answer no. An incremental 200 or 300 basis points per year would not allow me to change my job, allow me to feel greater financial security, or freely pursue my interests. I might be able to retire a year or two earlier, or live more comfortably in retirement, but that's it. In order to feel a change to my normal way of life, an outsized return is required. That leads me to reasons why I don't like stock market investing in general. The first reason is that in order to earn outsized returns, a diversified strategy will not work. Stock picking is required. I don't remember a lot of quotes from my college professors, but I remember at least one. An investments professor said that if you want to get rich in the stock market, invest in one stock. He followed that up by saying, if you want to lose all your money in the stock market, invest in one stock. So the strategy used to maximize your returns is the same strategy that could potentially lead to a total loss? I don't know about me, but are there any takers out there? Another reason I do not like stock market investing is because of the randomness that McLean describes in his book. Generally speaking, mutual fund managers attempt to outperform an index, typically the S&P 500. Historically, the return has been in the 10 to 11% range, depending on which time period is used. However, the majority of funds do not outperform the benchmark. According to David Granahan for Go Banking Rates, roughly 79% of mutual funds underperformed the S&P 500 in 2021, a figure that has grown 86% in the past 10 years. Returns can also vary drastically as funds target many different assets, sectors, and companies of different sizes, as is the case with stock market mutual funds. For example, the energy sector has performed extremely well in 2022. A mutual fund heavily weighted toward energy is likely to be outperforming other funds with no energy exposure. An experiment in McLean's book proves this point. He had blindfolded monkeys, literally, throwing darts at a dartboard to pick stocks. These random choices actually fare better than professional money managers. How can that be true unless the market does follow a random walk? In a recent article, the Wall Street Journal replicated the experiment, and their returns using random stock picking were around 80%, and professional money managers only earned 24%. The one shortcoming in these experiments is that they were only run for 1 year, and thus we were unable to evaluate volatility. After all, the goal is a higher risk-adjusted return. Because of a lack of volatility data, I set up my own experiment. These were the steps. Step 1. Obtain historical stock market performance for the individual components of the S&P 500. Step 2. Set up 2 different stock picking methods. Method 1, pick 10 stocks at random and hold those same stocks over the analysis period. Method 2, pick new stocks each year in the analysis period. Step 3, calculate the annual return for the portfolios in both methods, assuming equal investment dollars per stock, not an equal number of shares. Step 4, calculate the standard deviation of returns of the entire portfolio to measure volatility. Step 5, compare the risk-adjusted returns for each method to the return of the S&P 500. The method we used to calculate risk-adjusted return was what is called the Sharpe ratio. The Sharpe ratio is calculated by subtracting the risk-free rate from the observed rate of return and dividing that result by the standard deviation. A few notes to the process. Due to data constraints, we could not draw from the entire S&P 500. Instead, we only used the first 250 companies alphabetically. Additionally, our investment period was 2015 to 2023, again due to data constraints. The results were, to a data nerd like myself, quite fascinating. In the trials I ran, random stock picking rarely underperformed the index and in many cases outperformed it. Now, these results might not correlate with future returns, but it is further evidence supporting the difficulty in predicting or forecasting future stock performance. Even if you want to ignore randomness and the risk of asset bubbles, perception has too great of an impact on the price of stocks, in my opinion. Here's an example. On May 30th, 2024, Salesforce, with the ticker CRM, reported earnings growth. which is good news. However, the stock price dropped a significant 19.7% the following day. There are a couple of reasons for this. One, missed revenue target. While earnings per share grew, Salesforce fell short of analyst expectations on revenue, which is a key metric for growth. Two, weak guidance. The company's guidance for the next quarter was lower than anticipated, suggesting a potential slowdown. This combination of factors caused investors to lose confidence in Salesforce's future prospects, leading to the stock price decline despite the earnings growth. I completely understand the mechanics here. A stock's price is dependent upon future growth prospects. If future growth prospects are reduced, then sure, the stock's price should come down. But 19.7% after the company reported earnings growth? I don't know. It just seems that a 20% reduction in value is too large of a swing given the results that Salesforce reported. If the stock market wasn't the path I took to riches, or at least the pursuit thereof, how did I get where I am today? Please remember that what follows should not be considered investment advice. Please consult an investment advisor before making any investment decisions. My career goals were centered around having the proverbial seat at the table and earning enough to achieve financial freedom. Investing in public equities wasn't going to work for me as discussed above. The next big idea was to rise through the ranks of a large company. Problem here is that there is a huge discrepancy between senior management pay and worker pay. For example, when I worked at a publicly traded company, I made in the ballpark of $100,000 per year. My direct supervisor was a senior VP and reported directly to the CEO. So I was 2 levels down from the CEO. Even being only 2 levels down from the CEO, the pay discrepancy was huge. If my memory serves me correctly, the CEO made around $2.3 million and my boss made around $800,000. The pay ratios were about 23-1 and 8-1 respectively. Working for a large company would only work if I was able to reach the very highest echelon within the company. End result? Increased risk. Additionally, perhaps I am in the minority here, but I have a general distrust for large companies. One reason for this is that managers expect a level of loyalty and commitment from the employees that the organization is unwilling to reciprocate. End result? Increased risk. Finally, and most importantly for me, I just wasn't cut out for large company life for a multitude of reasons. I didn't think of myself this way at the time, but I'm an entrepreneur at heart, and that doesn't mix with large company bureaucracy and the slow pace of change. End result? Increased risk. Investing in large companies and working for large companies were both out. Through all of this, I felt like I was missing something. From time to time, I would think back to certain experiences from college and even some classes. One class that kept coming to mind was an engineering finance class that taught students how to analyze the financial impacts of purchasing a new piece of equipment. We would assume a certain cost for the equipment, incremental revenues and expenses, and then discount the cash flows to calculate a net present value. If the net present value was positive, it indicated returns were greater than our cost of capital and that the project should be pursued. Incremental cash flow wasn't guaranteed, but if I were the decision maker at the company, and if all else failed, I could pound the pavement to drum up sales and help affect the result. Here was a scenario in which I could invest in a physical, income-producing asset, and if performance wasn't what was expected, I could take matters into my own hand to improve the situation. And that's when the light went off. So much of what I didn't like about investing in public equities or working for a large company was the absence of control. Public equities, if you believe Malkiel, exhibit a random walk. Working for a large company isn't a random walk, but you certainly do not have much control over your career, even if your supervisors try to tell you that you do. The conclusion for me? Ditch public company investing, forgo a corporate career, and instead pursue small company ownership. I liquidated my 401k, as did my business partner, and we set out to buy 2 businesses, one for me to run and one for him to run. We launched 4 Pillars in 2015, bought our first business in 2016, which I ran, and our second in 2017, which my partner is still running to this day. Though our strategies have changed a bit over time, with the exception of creating a diversified portfolio, much of our strategy is in direct opposition to investing in public equities. First on our list of priorities is avoiding asset bubbles. We do this by maintaining pricing discipline. When I say pricing discipline, what I mean is that we have a standard view on valuation and structure. We typically value companies somewhere between 4 and 6 times EBITDA and require that the sellers have some sort of ongoing financial interest in the company post-close, usually through rollover equity or seller financing or some combination of the two. Even though we sometimes would like to chase companies and pay higher multiples, we resist that urge unless there is a very compelling reason to do so. Proportional to our dislike for asset bubbles is our desire to find undervalued assets. Now, this is not trying to buy a business for less than market value. Instead, it relates to the market of transactions as a whole. It is commonly accepted that larger companies trade for larger multiples. One such dividing line is $5 million of EBITDA. If we buy a business with EBITDA of less than $5 million and grow it to greater $5 million, then the multiple we sell it for will likely be higher. Secondly, we disproportionately allocate excess cash to the most attractive projects and/or companies. This would be in contrast to index investing, since every dollar of investment is invested pro rata to the companies in the index. Third, we invest where we think we can add value by being active in the business. We are not passive investors that attend the quarterly board meetings and try to manage the business from the proverbial ivory tower. For 4 pillars, being active starts with getting to know the people. Given the size of some of our portfolio companies and the geographic distance from Kansas City, I will never know the names of every employee. But developing relationships with the key managers is vital. Though relationship building is ongoing, another required activity in our minds is developing a strategic plan. I've done an entire video on what strategic planning is and how 4 Pillars executes the strategic planning process. In short though, the company needs to have goals, and the people of the company need to be aligned on the objectives required to achieve those goals. Those goals often center on growth, which could be organic, M&A, or a combination of the two. This analysis will often start with the growth potential for the industry as a whole, and then the focus will narrow to the individual company. The strategic planning process isn't the first time we analyze growth potential though. That process first takes place during our diligence process prior to buying the business. During our diligence process, we also look for what we call life cycle growth potential. Life cycle growth potential is the term we use to describe a company that has the potential to grow, but is being held back by current ownership. That sounds bad, or at least somewhat critical, but it is not meant that way. In many family or founder-owned businesses, growth is no longer a priority for the owner. This might be due to age/retirement related issues, asset diversification goals, or perhaps lifestyle priorities. Age and retirement issues are fairly easy to understand. Asset diversification relates to the likelihood that the business owner's largest asset, by far, is probably the business. Investing further in the business would further decrease diversification, which is even riskier with shorter investment horizons. Lifestyle priorities might be around grandkids, golf, or other hobbies, or standard of living. Talking more about standard of living, the companies we target have at least a few million in earnings and probably have had that level of earnings for several years. Does growing the business from, let's say, 3 million of EBITDA to 4 million really improve the quality of the life for the owner or his family? In many circumstances, I have been told the answer to that is no, and I would agree with that. The final type of growth potential we look for relates to sophistication. Our experience has been that companies with revenues in the $20 million to $100 million range have started down a path of increasing sophistication in the business, but might have room to grow or improve. My background is industrial engineering, which has ingrained in me a process orientation. I often evaluate a target based on the extent to which the company is driven by defined and optimized processes and procedures, and the potential benefits if the company improved in this area. We went through this exact process in our diligence on our first portfolio company, Southwest Steel. First, we analyzed the industry, including local competitive dynamics. We felt there was organic growth potential here, but were more excited about the growth potential via M&A. Life cycle growth potential was more exciting than organic growth potential though. The former owners had decided against purchasing a certain type of equipment because it was too costly. We performed our own analysis and felt that we could make it work with used equipment. Fortunately, we were proven correct. Finally, we evaluated the level of processes and procedures. On the one hand, we had a plant manager that resisted implementing lean manufacturing techniques. On the other, we had a CFO that prepared monthly financial statements on ledger paper. Were those correct or incorrect positions? That is not really the question I would ask. Instead, the question I would ask is whether those conditions suggested that the company could improve via the implementation of processes and procedures. After almost 10 years of operating under our own banner, we have closed 7 deals with 6 companies in our portfolio at present. By the end of 2024, those numbers will be 10 deals closed and 8 to 9 companies in our portfolio. We are by no means perfect. At times, we haven't even followed our own processes. But I can tell you this, when we have gotten into trouble, it was a whole lot better knowing that we would be the ones that had to dig ourselves out of the hole as opposed to waiting for someone to help us. Have you heard the adage that most family businesses fail after the 3rd generation? I have to say that I don't really believe it. There was recently an article in the Harvard Business Review that indicated that the study is outdated and quite flawed. It was a very small sample size done on manufacturing companies in the 1980s. And on top of that, the HBR indicates that the results of the study were interpreted in a flawed manner. Even though there are a lot of strengths and a lot of weaknesses as well, it's something that, in my view, you have to be intentional about and understand the benefits and some of the shortcomings are if that's the route you go. Stay tuned as we talk about many of those and also learn about how to think about when and why to have family in your business. First, I'll start with the benefits. I'm a very family-oriented person. My kids are still young. I have a 7-year-old son, and my daughter, just turned 6 yesterday, actually. And so, man, the prospect of working with my son and or daughter in the business and getting to spend all that time with them, that would be great. Who wouldn't enjoy that? There's other concepts involved. Blood is thicker than water. You can trust these people. You can trust your family more than somebody that you just met. Also, the idea of if my son or daughter are, 20, 25, 30 when they start working for me, I will have known them for 20, 25, or 30 years, and surely I have a better assessment of what they can and can't do. Then those are definitely some key benefits. One caveat I would say that in some family businesses, it works until it doesn't. We've done some videos on Succession in the past, and I'd like to point you to the first season of Succession. If you look at the first few episodes, what you see is that the son seems to be primed, at least in his mind, to ascend to the position of CEO. You can make the assumption or the inference that over the past several years, he's been working his way up and has demonstrated some success. And now it's to the point where, based off some discussions between the son and the father, which the audience is not privy to, pretty soon the son's going to get promoted to the CEO position. This is really where the relationship really goes off the rails, at least in my opinion, because whenever the son doesn't get picked for that spot, or whenever the father is reluctant to announce it, man, all sorts of bad stuff starts happening. And I don't want to ruin the whole series for you, but it was that point where everything had been going along pretty well. The son seemed to be, having a good relationship with his father, seemed to be, doing well for the company and whatnot. But it hit that point, and whatever was working no longer was working anymore. There's another example that's closer to home for us, because this was a company that we don't own or we're even thinking about buying, but we just knew some of the players involved. It was a family-run business. The father had at least 2 sons. One son was working in the business. The right-hand man to the father is how it was understood. The other son was working out of state in some tangential industry, but not the same industry. The father died somewhat unexpectedly, and now all of a sudden, the older son wants to come back and take over the business. What's right? Maybe the older son would be more competent to take over the business. But the point here is that having family in the business, at least from the outside perspective, was working for a while. The older son wasn't upset about not being in the business. The younger son was learning the trade, so to speak, and was primed to take over. And then all of a sudden, the father dies somewhat unexpectedly, and now you have this turmoil and you have this conflict. Ideally would have been avoided. Even if having family in the business continues to work for you, at the very least, having children and other family members in the business adds complexity. So continuing on the theme of succession, if you look at the 3 siblings, perhaps not all three, for their entire lives wanted this, but at certain points in the series, all three were vying for the top spot. Now, as a father, I mean, I don't really want to have that competition between my son and my daughter, that where my son's competing against my daughter to be the CEO of the business. And my son and daughter, it's 17 months apart. It's not a situation where there's like 10 years or 5 years of difference. So like you can make one CEO for 5 years, and then if my son were 5 years older, have him be the first CEO for 5 years, and then my daughter be CEO for 5 or however many years. I mean, that certainly won't work, but maybe that's okay for certain of other, personality types or whatnot. But to me, I just don't really want to be put in that position. If you look at another TV series that we've talked about on the channel, Yellowstone. Here's another example where there are 3 siblings that are involved in the business. This isn't a situation where all 3 were vying for the top spot, because I think that in Yellowstone, all 3 just wanted to make sure that the ranch survived and thrived for many future generations. So what you see in Yellowstone, though, is you see 3 very different approaches by the siblings. You have the attorney who has his own style. You have the daughter who has definitely her own style. And then you have the veteran that still has some trauma associated with serving in the armed forces, who has his style as well. And even though they are not coveting the title of president or CEO, you're still being put in a position where you have to prioritize the goals or the proposed strategies of one of your children. And to me right now, I'm struggling with trying to figure out a TV show that my kids can agree on. So maybe it gets easier whenever they're 30, 40, 50 years old and we're talking about strategy for a business. But it's one of those things where if you look to Yellowstone, it says no business at the dinner table. Well, that's a great rule to have, but doesn't always happen. And that's the type of situation that I would be fearful of or would want to try to avoid. Additionally, what you're seeing in this day and age is just that the gap between parent and sibling, the age gap, is much larger than it used to be. That presents its own challenge. Whereas in the past, the father or the mother, whoever might be ready to retire, and the son or daughter would only be 20, 25 years younger, and they would be more likely in a position to be ready to be promoted to president or CEO. You have some people that they're not having kids until 35, 40, 45. You're in a situation where the kids aren't quite ready to be CEO or president. And what do you do in that situation? It's a situation by situation decision that you would have to make. It hits home the point that having children in the business, adds just one additional layer of complexity. I will say though, there is a critical distinction between having children in the business and having children be the future owners of the business. If the children aren't in the business, they're just more owners, then I think you eliminate some of the complexity. However, as I think about how I would like to transition my business, and just as a reminder, I have one equal partner, I don't necessarily want to see our kids be the CEO or president of those businesses. However, I would very much be in favor of our kids, jointly owning the business in the future. Let me give you a little bit of context there. My family and my partner's family, we went on a vacation to a beach area. The kids, they had so much fun together. They still talk about each other, and it would just make me so happy if my kids and my partner's kids were always that happy about seeing each other. The last thing I want to do is have them be owners or employees of the business and they're at each other's necks because they're ambitious and want to get to the top spot or this or that. Additionally, when I think about bringing kids into the business, my current viewpoint, I would like to see them have success in a similar role in a business outside of the family business. Am I really gonna hold on to that for the next 10, 20 years? I tend to be a pushover when it comes to my family, and so that might be a bad decision, but let's just say I wouldn't be too surprised if I get a little bit softer on that viewpoint. However, at some point, you are going to have to put the business first or your family first, or maybe one family member over another family member. Here's where we get to the conflict or the inconsistency that we have to reconcile, because sure, I may be putting my kids desires at that particular moment first, but really what's in the best interest for my kid? Is it being allowed to take on a position at the family business? Or would it be in my kid's best interest to, hold firm to that rule and make them have a leadership role in some other company? Probably you hold firm, but here's an example where think about young kids and eating habits or sleeping habits or watching TV. I mean, sure, it's best for them to have broccoli at every meal or every day, but do you always do that? No. Would they be healthier if you did? Absolutely. Sometimes you make decisions based off of convenience or laziness or whatever that, short term are, what you would like to see, but long term probably aren't as positive as they could be. Those are the types of issues that you're going to have to deal with. Maybe you're fine with that, maybe you're not. I'm not, sitting here trying to tell you to have family in the business or not to have family in the business. However, the main point is I just want to at least shed some perspective on some of the strengths, some of the weaknesses, some of the things you have to watch out for when thinking about whether or not you should have family in the business. I'm a firm believer that there are 1,000 or 1,000,000 different ways to raise a child successfully. I'm also a firm believer that there are 1,000 or 1,000,000 different ways to run a business successfully. And some of those ways involve having family in the business. Some of those ways involve leaving family out of the business. Regardless though, going back to the myth about most family businesses fail after 3 generations, if you look at some of the more recent data, you'll actually see that family businesses tend to survive longer than private companies. I mean, if you look at some of the biggest family-owned businesses, these businesses really seem like they'll stand the test of time. I mean, you got Walmart, you got BMW, you got Porsche, these names that everybody is familiar with, on top of industrial giants like Bosch and some of these others that are going to be around for a very long time. Focus on building a strong business. I mean, if you focus on building a strong business, having family in the business or not having family in the business, it's probably not going to be the determining factor in whether your business succeeds. The main thing for me, whenever we're working with our businesses and whatnot, is be intentional about your decisions. In other words, make the decision, for a reason. If you want to have family in the business, make sure you're doing it the right way so that you're developing your kids so that they're going to be successful when they get into those roles. If you don't want to have family in the business, then you need to set up expectations with your kids so that they know that they can be involved on an ownership level eventually one day, most likely, but they're not going to be in the business, and they need to find ways to contribute to the family, to society in other ways. It's not always what the decision is, it's how the decision is made, how it's communicated, and how it's ultimately carried out. I'm sure you've read about the layoffs from the tech industry to Wall Street to pretty much any industry. And, actually small businesses are struggling too. I mean, it's tough to be a small business. Stay tuned to not only hear about my experiences, but also my thoughts on what it takes to be a small business owner and the challenges that you just simply must overcome.
Tech companies have announced another round of job cuts.
Facebook and Instagram has started its latest round of layoffs.
LinkedIn just laid off nearly 700 employees. Qualcomm is planning to.
Microsoft is laying off hundreds more local employees starting on May 5th.
There are many CEO peer groups out there. One of the ones that I've attended a couple of times is Visage, which I think is a great group. And it was really interesting, one of the meetings I went to, because, you go there, you think everybody's very successful, and, I knew some of the folks there, and I knew for a fact that they were very successful. And it's just so interesting because somebody commented about how hard it was at one point in their business's life to make payroll. And I'm just thinking, man, I didn't really realize that idea that everybody who owns a business at some point probably struggled to make payroll. That kind of opened my eyes to the concept and the thought that, as good and as successful as some of these businesses look, if you peel back the onion a little bit, it's still probably going to be a healthy company, but it's just not as easy and great as it might seem to be on the outside. So it's great to know other people have been through that, and it's a little bit reassuring, but it really doesn't, just the knowledge isn't enough. I mean, you really need to go through that yourself, at least in my opinion. As the CEO, you are getting hit from employees, from suppliers, from customers, from various stakeholders in the community and whatnot. And even though they're not all talking to you about the same time, a big part of your job is not only engaging with that stakeholder and making sure that they feel like their input is valued, but it's synthesizing all the data coming from many different directions. The most challenging period was when I was CEO of a company, and we were really in a dark period. I'm gonna be honest with you. And it wasn't just one factor. The interesting part is it was really like 3 or 4 different factors. And if it had only been 2, then it would have been a lot different situation. But it was really 4 that all happened, not on the same day or the same week, but really 4 that happened over the course of, let's call it 3 or 4 months. Now, I don't think the specific examples are important, but I think the types of examples were important. One of it was, general economic conditions. A couple of others were the fact that internally we made some mistakes. I don't want to, sugarcoat it. We did make some mistakes. And then third, it was a variety of projects all culminating at the same time. Our customers all wanting their project to be prioritized, and you know how that goes. I mean, sometimes you can do it, but if all your customers are clamoring at the same time, somebody's probably going to get the short straw. And that's what happened. And talked about making payroll, yeah, I mean, there were some periods there where it was razor thin and it was very stressful. But in terms of thinking about how that shapes you as a CEO or a professional, I mean, it really gives you a lot of confidence whenever you're facing other issues in the business. If you haven't been in that situation, I don't think you can fully appreciate the stress and all the pressure of that situation, in that if you don't make payroll, people aren't going to be able to put food on the table. I mean, it's not just like it's an embarrassing situation when like a check bounces or you forget to make a utility payment or whatnot. It's much more dire than that. And that pressure is how you eventually get strengthened, so that whenever there's a big decision about a specific strategy or how you want to deal with a customer or whatever, I don't want to say it's easy, but in terms of the ramifications, you just feel more confident in making those decisions because of all the challenges that you've been through prior to. But, there have also been challenges at some of the companies that we've been, or that I've just been a board member on. One example is with a specific customer. Whenever we were analyzing the customer relationship of this acquisition candidate, it was a situation where one of the key customers wanted their supplier to grow with them. And the owner just said, listen, I'm comfortable where I'm at right now. I'm just not interested in buying 3 or 5 pieces of equipment to pursue that growth and whatnot. The interesting point is that even though the customer continued to send business to the company that we were considering buying, or that we did end up buying, what we didn't know until a few months afterwards is that they were trying to replace that supplier because the supplier wasn't growing fast enough with them. So now we're 3 or 6, I mean, I'm not sure exactly what, but relatively short period of time, in having owned this business, and we find out that one of our major customers is threatening to leave. And what I will tell you is that what really saved us, my partner, who was the CEO, navigated the customer relationship. I mean, I almost think he did it perfectly. I mean, the relationship was repaired. We proved that we were willing to grow, and it's really going to be a great story. And kind of coming back to, one of the 4 pillars of our name, relationships as a cornerstone for success. I mean, boom, like right there, that is a great example of how we really lived one of our 4 pillars, as in terms of building that relationship, so that not only we could repair it and make sure that we maintain the level of business with that customer, but we could actually have a great growth opportunity with that customer. I mean, I've talked a little bit about how some of these challenges make you into a stronger person or a more confident leader or whatever. And definitely, I think that's very important. But also, I think those things are important when you're thinking about who you want to sell your business to, and or whether or not 4 Pillars is an attractive investment partner, whether or not you want to invest in some of the deals that 4 Pillars is buying. And what I would tell you is that absolutely this experience is important. In our industry, what you see is that you see a lot of private equity firms that are started by members of previous private equity firms. So, let's say, Joe or Sam or whoever used to work with private equity company XYZ. They worked there for a few years and now all of a sudden they decide they want to start their own private equity company. They call it ABC, and maybe the strategy is tweaked a little bit, or their prior firm was on fund like 7 or 8 and it was just getting to be so large where they had to pursue larger deals, and now a couple of people spin off to go back to pursuing smaller deals or whatever, and that happens a lot. I'm not being critical of it. I mean, it's just how it is. And so absolutely, those guys that create those spin-offs have a lot of experience in private equity and they clearly know what they're doing. However, what I would say is we have a different type of experience. I mean, we are definitely entrepreneurs first. We have been in the trenches. We have been leading companies whenever they've been through challenges. And why is that important? Well, one, I always think it's good to have walked in the shoes of whoever you're working with, especially on a big deal. If you're selling your business, I would like to think that it might feel a little bit better to know that the person you're selling your business to, or the group or whatever, has run companies, has struggled to make payroll or whatever, and has the chops to get through that. The second one though, and I think this is equally important to business owners or potential investors, is really just the idea that we have the experience of going through challenging situations, and we've been able to get those companies through those challenging situations and ultimately make them very successful. So from the business owner's perspective, whether it's challenging macroeconomic conditions or new competitor or whatever, the case that I would make is that we've actually been in those situations because we've been running businesses that have encountered those situations. From an investor, maybe we don't foresee something, but the business gets in a pinch. Well, would you rather have somebody leading that company, at least on the board level, that has actually gotten the company through a challenging period? Or, would you just like somebody that probably hasn't had that experience? When you think about the values that we have at 4 Pillars, relationships and challenge the status quo and all the others, we seek to partner with business owners and investors that buy into this concept, the concepts of, relationships as a cornerstone for success. What's the difference between a company that's worth $25 million and a company that's worth $10 million? There could be lots of factors. However, for a range that significant, a key possibility is significant customer concentration. What really is significant customer concentration? It's when a high percentage of your revenues come from one particular customer. So for example, for most people, customer concentration would be anywhere north of probably 30% of your revenues coming from one customer. We've seen customer concentrations as high as 80, maybe even 90%. Now, there's a lot of debate as to how important customer concentration should be in the value of the business. And what's the percentage cutoff? Is it 30%? Is it 50%? Is it higher? I'm not going to try to settle the debate on that topic, because I think everyone at the end of the day will have a different opinion on what that ratio is. However, I do want to talk about how customer concentration impacts the value of the business, how it can be addressed, and how we think about it here at 4 Pillars. At the high level, I think customer concentration is relatively easy to understand. Oftentimes it's not just one particular plant, it could be several plants, but all tie in up to a larger customer. Why is customer concentration so important? Well, at the end of the day, whenever you think about why a business has value, one of the most dominant themes is trying to think about how repeatable and consistent the company's cash flows are. If a company has a single customer that is responsible for 40, 50, 60% of their revenues, if that customer goes away, that company is in trouble. I talk to a lot of business owners and they say, listen, I understand we're highly concentrated with customer XYZ, but these guys are great. They love us. They would never go anywhere else. And give you all these reasons as to why the company would not go with a different supplier. In several circumstances, that makes a lot of sense. However, there are so many factors outside of our control that creates a situation where that dynamic could change. So for example, if you really have a great relationship with just a small handful of people, if one or more of those folks go on to another opportunity or leave the company, you're in a difficult situation. But that's really an extreme where you're doing so much business with one customer and they just completely go away. What we've seen happen in some of our portfolio companies is a little bit different, but again, points to the risk of customer concentration. For example, in one of our portfolio companies, great relationship with the customer, we're critical to what they're doing. Perhaps they're trying to find other people to do what we do, but at the end of the day, they still need us. That hasn't changed. There are some internal dynamics within the company whereby they change their product strategy a certain extent. We didn't lose out on all of our revenues from that company for a period of time. There was a month, maybe 2-month stretch where our revenues were down significantly from that customer due to those internal product changes. We still have a great relationship. They're not going to go anywhere else, but we lost out on the majority of revenue from this customer for a month or two because of those changes. That's a key customer concentration risk and why it can decrease the value of the company. Another example with one of our other portfolio companies where a customer was running a large promotion. Because of this large promotion, we had decided to dedicate most of the plant's capacity for a couple of months to that particular customer. The promotion got delayed and we were able to move around production, and it wasn't a situation where we lost all of our revenue for those 2 months because we were able to work around it. But again, that's the point that I'm trying to make, is that even if you don't lose customers, there's a potential for factors outside of your control to have a meaningful impact on your annual revenues, even if it only happens during a month or two of that year. In addition to the revenue considerations, there are also working capital implications. What we have seen from certain customers is that they try to increase terms from 30 to 90 days. We always push back. Don't get me wrong, we always push back. It's just we're successful sometimes, unsuccessful in other times. If you have a customer that's 50-60% of your revenue and they increase terms from 30 to 90 days, that will have very meaningful impacts on your working capital, which really means that you're going to have to put more money into the business. In addition to customer concentration, though, there are really a few other types of concentration that should be considered. I wouldn't say these are quite as acute as customer concentration, but again, these are all factors that need to be evaluated. One is industry concentration. If many of your customers are all in the same industry, there is a risk of that, because what if there are macro factors that affect that industry? Now, typically not as important as industry or customer concentration, but supplier concentration can also be important if you're getting the bulk of your raw materials from one supplier. Another type is product concentration. If you're selling 80 to 90% of your revenues or even less, and it's one product or one product family, what happens if that product falls out of favor? Now, that's probably not going to happen, again, in almost all circumstances, but from time to time, issues do creep up. What if there's a manufacturing issue in that line that calls for a manufacturing change, or what if there was a defect that's missed? These are the reasons why a diverse group of customers, a diverse group of suppliers, diverse group of products, etc., helps increase the value, because you decrease the risk of any one event impacting the lion's share of the revenues and ultimately of the company's cash flows. As a business owner, what happens when demand from your customers exceeds your supply? Is it riskier to add capacity, whether that's people or equipment, or actually is it riskier to not add those people and or equipment? If you think about how it might be an offensive mindset, the idea is that you have to spend this money, you have to put more people on the payroll. That's risky. In order for you to want to take that risk, you need to be offensive to go after those additional customers and whatnot. I think that that's the more common mindset that many business owners would take. However, I'll be the contrarian here and say that I would encourage, in some circumstances, to take the defensive mindset. So you have some customers or potential customers that want to buy your products or services. If you don't have the capacity today, you're going to force them to take their business elsewhere. I don't want to send prospective customers to my competitors. Not only does it decrease the likelihood that I'll be able to win them back, but my competitors might have a unique feature or this or that, and they might want to shift other business to them. And so end result is that I might want to add capacity to defend against the situation of my potential customers using my competitors. From the perspective of the small business, we have been in this circumstance many times. Most notably was in one of the acquisitions we pursued. We had a business owner that did not want to grow with their customer. He was very comfortable about the size of the business, the revenues, the earnings. For that reason, he wasn't willing to buy new equipment, add additional staff, etc., etc. We thought that going forward, we had the opportunity to grow with this customer because we had a growth mindset. A few months post-close, what we realized is that the customer was actually on the verge of leaving this company entirely because they had not been keeping up with them for such a long time. It turned out that we had a lot of work to do in order to make sure that we were able to maintain this customer. What I will tell you is that we secured the relationship, and it's going to be a growing relationship and a very solid one. This is a great example of how I would have suggested, or it would have been beneficial to that owner to take a defensive mindset when thinking about whether or not he should grow with his customers. Tony Robbins is credited with saying, if you're not growing, you're dying. And I believe that. However, as it relates to whether or not growing and adding capacity is offensive or defense, I do think it matters, what type of growth you are pursuing. Is it more speculative in nature, or is it merely to satisfy the increasing demand from your customers? Now, I know in some of the companies I've worked for, they increased demand. It was really a combination of speculation and increased customer demand. And I think that that's really probably a good blend of riding the line between being aggressive towards growth and merely keeping up with your customers so that they don't seek alternative suppliers. However, on the other end of the continuum, where it does get risky is when it's speculative, whenever you're putting growth above all else, even though there might not be the support for it, or you might not have the experience perhaps to pursue a new product line or a new service line. Now, there's an alternative strategy about supply and demand, but largely that is in luxury goods makers. Some luxury goods makers will actually decrease the production so that there's scarcity for their product. Not only can they charge higher prices because the demand far outstrips supply, but there's an aura, a cult-like desire for people to want to own these products. There are risks to that strategy as well. So for example, there's this popular bag by Hermes called the Birkin bag. Now, Hermes already charges like $10,000 or $15,000, and what I've heard is that on second-hand markets, those bags can go for like $25,000 or $50,000. But the question there then is that a good strategy? And if it is a good strategy, is the company charging enough? They're able to get 2 or 3 times the MSRP on the secondhand market. Man, I think you can make a strong case that they aren't in fact charging enough. I know it's a great spot to be in whenever the demand from your customers or potential customers exceeds your supply. However, my question for you is, what's your typical style? Are you going to think of the fact that adding people and or equipment is risky because you're being aggressive in your pursuit of growth? Or is your natural style to take a defensive mindset and think, if I don't meet the demand of these customers, they're going to go elsewhere, and that's a risk to my business? There's always new abbreviations coming out like SMB or ETA or LMM, and at this point you might be thinking WTF. Well, in today's video, I want to talk about different flavors of private equity and M&A that are very common today and really highlight the differences between what we'll call SMB M&A and LMM or lower middle market private equity. Stay tuned. My name is Nick McLean. I'm the most boring guy in private equity, at least in my opinion, and I've spent about 15 years in and around M&A, private equity, and investment banking. So there are a lot of different terms to describe SMB M&A, small medium business M&A. You might hear ETA, which is entrepreneurship through acquisition. You may hear the term Main Street deals, or you might even hear about search funds. Those are all, another category of M&A is what's called lower middle market or middle market private equity. Now, at a high level, I think it's easy to categorize those based off of two different criteria. One is size. Typically SMB or ETA is going to be small enough that you could use an SBA loan in order to fund a large portion of the transaction. So if you're not familiar, SBA loans are typically $5 million. Lenders can do what's called a pari passu conventional loan that partners up with that. But generally speaking, for these SMB, SBA, ETA type deals, you're looking at EBITDA of somewhere between $500,000 to $1.5 million. Now, I will say that there's a kind of a no man's land between $1.5 million to $2 million, because sometimes deals in that size range are a little bit too large to get done via SBA, but still a little bit too small for lower middle market private equity. Looking at lower middle market private equity, it's, I would say, 2 million in EBITDA and larger. Now, if you go on the internet and you say, what does lower middle market mean? You might find different size criteria. It might be based off of revenues or enterprise value or all these other things. But the reason why I say 2 million is because, in my experience in working with private equity firms, the lowest most private equity firms will go in terms of EBITDA is 2 million. So that's kind of how I define the lower middle market. The other broad category I would say that they differ in is level of involvement of the person leading the deal. So on a ETA SMB deal, usually the seller is looking to transition out of the business. There's no one within the business to take over. And so the person running the deal is actually going to work as an employee in the business as president, CEO, whatever they want their title to be. In lower middle market private equity, that's typically not the case. It's still common for the owner, the seller to transition out of the business, but typically the companies are a little bit larger, so their ranks are a little bit fuller, and they might have somebody to ascend into that role of president or CEO. Even if they don't, typically what we would do is find somebody to put into that role. So even in circumstances where there is not an heir apparent, a person working in lower middle market private equity is probably not going to step in and be president or CEO of that portfolio company. Those are the two biggest categories. However, there are certainly more that are more philosophical differences, if you will. The first philosophical difference I would say is at the individual level in terms of the actual person. And how that relates is the mindset or how that person thinks about growth. From my perspective, many SMB or ETA folks are thinking about growth as a long-term thing. Let's call it 10 or 20 years. Most of the growth, at least in the early years, is going to come organically as opposed to via M&A. The type of or the level of growth that they're expecting is many-fold. The company might have 2, 3, 5 million of revenue now. Many folks within SMB or ETA are gonna, really target, double, triple, quadruple the revenues over that, 10, 15, 20 year hold period. Lower middle market private equity is a little bit different. I would say in terms of the perspective, it's definitely going to be shorter term just because private equity funds have a defined life or duration. Additionally, in terms of growth, the organic side of growth is going to be more modest. However, there might be a more aggressive component of growth that they would try to achieve via M&A. Another philosophical difference is at the company level. It's the level of sophistication within the business. Now, if you look at a business with, again, like 5 million of revenue or so, you're going to have a lot of that keep a lot of the knowledge of the business in their head. And the reason for that is because the business is small enough for that to be possible. If you only have 3, 5, 10, 20 customers, a lot of times you have personal relationships maybe with all those customers, and it's easy for you to keep track. But as that number of customers grows from 20 to 100 to 1,000, it can quickly get way out of control. And if you don't have processes and procedures in place, then it can destroy the company. You can just get overwhelmed and overloaded. And so as you look at the difference between SMB and lower middle market, again, the smaller businesses, they don't have those processes and procedures a lot of times because they don't need them. It's not until you start to get a little bit bigger where the challenge to keep everything in your mind gets more difficult and almost to the point of impossible, where it's out of necessity that these larger businesses start to implement processes and procedures, not only so that you don't have people keeping it in their head, but if Joe's really good at this, you want to be able to promote him to do something else. But if there aren't processes and procedures for the next person to take it over, that sometimes presents a risk. So lots of different reasons why the level of sophistication, the processes and procedures and whatnot are at a higher level as you look at larger businesses. The final area that is different is what the company needs for growth. So if you look at SMB, it's really a lot of times there are things that are needed that are more blocking and tackling, if you will, like the fundamentals of business. Perhaps there hasn't been a robust or even an effective accounting system that has been implemented. There hasn't been a way to track expenses to particular customers or products or service lines or whatever. And that really impacts decision making and how you think about growth. Additionally, what I would say is that a lot of times the whims of the owner are really what are pervasive throughout the business. You could be talking to somebody that's operating a machine and they say, well, Joe, the owner, doesn't really like to do it that way. It's pretty impressive that all the way at the operator level they know what of the owner would be as it relates to certain processes and whatnot. As you get to companies in the lower middle market, sure, the desires and the goals of the ownership are known to some degree. Responsibility and whatnot gets diffused through the different layers within the organization, as you no doubt would understand. And so as you think about growth from the lower middle market perspective, it's less about the basic blocking and tackling and focusing on eliminating obstacles, more about setting direction. As you want to grow the business, what are the 3 key areas that the company needs to focus on in order to take that next step? Does M&A need to be a part of the strategy? Do you need more equipment, a new facility? Do you need a sales and marketing team? Those things aren't, easier questions to answer or harder questions to answer. It's just, it's different. Thinking about going after a new product line or a new customer or a new geography or whatever, it's just different than putting in an accounting system so that you can know what your margin is for a specific customer or product line or service line or whatever. Not easier or harder, again, just different. And when talking about putting in an accounting system, as a SMB owner, not only are you going to determine that there's a need for an accounting system, you're going to need to determine what the accounting system is, how it needs to be configured, and then largely you're going to be the one to implement it. I would say for lower middle market, it's at least a little bit easier because to the extent that there's a new process or procedure or some new initiative, at the level that we would be spending our time, it would really be working with the management team, think about what needs to happen or the best way to happen that, challenge assumptions, get them to look at it from a lot of different perspectives. But at the end of the day, since we're not employees, we're not going to be the ones that are actually executing that strategy, if you will. So perhaps that area is in fact easier, but regardless, it's 2 different skill sets. And so perhaps For some people, the setting direction is harder, and perhaps for other people, that actual implementation is harder. To wrap everything up, again, I mean, SMB is smaller than lower middle market private equity. I mean, that's just kind of how it is. I mean, one's not better than the other. I think that there's a lot of room for SMB to be more lucrative potentially than LMM. There's the potential for lower middle market private equity to be more lucrative than SMB. Really what it comes down to is the person. I mean, are you the type of person that wants to take one small business and grow it from 5 million of revenue to 10 million to 20 to 30, work there for the next 10 or 20 years and that really be the or are you looking to do something to where you can work on many deals, have less involvement in each particular deal, hold those companies for a shorter amount of time, and just burn and churn, so to speak, over the next 5, 10, 20 years? I think you can make an argument for both. However, for me personally, I ran a company. I was worked for a company that made widgets, and I enjoyed it. However, I realized that what I really wanted to do is I wanted to work on deals, and if I wanted to work on deals, I shouldn't be running a widget manufacturer. What I needed to be doing was running a private equity shop. And here we are. That's what 4 Pillars is. And you'll hear me say this a lot. Never claiming to be the most successful private equity firm out there. I think that we've got a lot of room to improve, a lot of room to grow. However, there are key things that I think that we are doing that we will always do that are going to be meaningful and resonate with business owners. And the key takeaway is that within SMB, there needs to be that relationship between the future operator or the current owner. That relationship is key. And that is one thing that we strive very hard for, is to develop the relationships with the sellers that we work with. Because, again, I mentioned this many times before, the first pillar of our name is relationships as a cornerstone for success. And when we look at different segments within the market, we try to look where we can take what works best in those different segments and apply it to our work. I will say that that's one area where I think SMB gets it right, is the relationship that they build with those sellers. What are 2 unpopular opinions I have about business? My name is Nick McLean, most boring guy in private equity. I have about 15 years of experience in private equity, mergers and acquisitions, etc. And throughout that 15 years, talked to a lot of different business owners, a lot of different people in business and in a variety of roles. And what I'll tell you is there's a few different common themes that I've heard, well, two in particular. When they're relayed to me, it's almost a source of pride. And over the years, I've started to realize that personally, I wouldn't be prideful about those things. And, quite frankly, that might be an unpopular opinion. But stay tuned to today, and I'll tell you about those opinions that I have and why I personally aren't a fan of them. Before I get into it, I'd like to talk a little bit about survivorship bias. Essential part of the survivorship bias is you look at the survivors and try to determine why they survived and try to get some learnings about the situation based off. And how that applies here is whenever I'm talking about some of these, you might think of, oh, well, company XYZ, they do it exactly the way you think they should not, and look how successful they are. Granted, there are going to be those exceptions. However, I kind of view those as the survivors, might be looking at who was able to succeed despite making these missteps, if you will. So again, I'm not saying I'm right here. I'm admitting that these are my opinions that are very possibly unpopular, but I just want to keep that in mind, that when looking at how companies are successful, there's a risk to using a survivorship bias and only looking at the successful companies. Now what are some of these unpopular opinions that I have? Well, the first relates to marketing. Many times I've been talking to a business owner and they'll tell me that grown their business to where they are today with no marketing, and they're very proud about that, actually. And I get it. It's look how my company has 20, 30, 40 million dollars of revenues, and we've only grown by word of mouth. We do such a good job for our customers. We don't have to market, etc., etc. I have 2 pushbacks to that mindset. Well, the first is been able to grow your business to 20, 30, 50 million of revenue without marketing. Think how big your company could be if you did have a effective marketing program, or you had more salespeople, or this or that. I understand that not everyone's goal is to grow the company as big as they should be, but again, my perspective is that if you were interested in growth at one point and you wanted to grow your company, then perhaps you probably should have maybe looked at marketing a little bit harder and thought about what you could do to market your company more effectively. The other point is a little bit more nuanced. Whenever we look at the companies that we're potentially going to invest in or purchase, always think about what levers we can pull in order to grow revenues. And the first place we always start within that analysis is sales and marketing. Even though we have a focus on sales and marketing, what I would tell you is that it's still hard to do. We're not perfect at it. We're gonna spend a lot of money or we're going to spend money, and if we had a crystal ball, then we'd be able to spend that money much more effectively and get much greater returns, or reduce the amount of money, only spend it in one bucket and get the same amount of returns. Whenever we see a company that has made an effort to implement a sales and marketing team or even just a sales and marketing strategy, that's attractive to us because we understand that we're not going to be solely responsible for figuring out the sales and marketing strategy, that we're not going to have to make all the mistakes, that some of the mistakes and learnings have already taken place, so that we can apply our experience and really help take the company to the next level. I can see how some people might say, well, yeah, you just want the current owners to spend all the money, make all the mistakes, so that you can come in and just reap all the benefits. I mean, that's not true. I mean, our perspective is that sure, there are going to be mistakes and inefficient use of marketing dollars before. I guarantee you, we're going to do the same thing. So it's not as if we simply want to just swoop in and we know it's going to be smooth sailing, just going to ride on not the coattails, but ride on all the hard work of the former owners and just have this great return. No, it's not that at all. It's a continually evolving process where look at what you've done in the past and it influences what you do in the future. And you know what? One of the other hard parts of sales and marketing is that what worked in the past isn't necessarily going to work in the future. So for all those reasons, we really are much more interested in companies that have the foresight to think about what an effective sales and marketing strategy might be, not only because it's likely going to lead to the company being more successful today, but we'll feel like we'll be in a better position to really help take that company to the next level over the next 3, 5, 7 years. The second unpopular opinion I have is about debt. Again, oftentimes we'll talk to business owners that will be proud or very happy their company has no debt on the books. And on one hand, that is good. It's great that the company is generating enough free cash flow to not only fund its current operations, but also potentially invest in growth and whatever the future might hold. So that's definitely I'll say. However, similarly to how we thought about market, we think the same way about growth. Was growth constrained because the business owner did not want to take on debt to buy a new piece of equipment or this or that? Again, this is nuanced. There's different layers of why this is or isn't a big deal. Is it purely just because the business owner has an aversion to debt and just does not want to have any debt on the books? Or is it something more? And what I mean by that is, sometimes we talk to business owners and they'll just say, oh, like it would be so easy to go out and get that business. All we've got to do is just do X, Y, and Z, and if we do X, Y, and Z, oh, so easy, we'll be able to get that business, no problem. And just sitting on the other side of the table, kind of thinking, okay, if these things are so easy to do, why haven't you done them already?
If it's so simple, why haven't you done them?
Sometimes we'll ask the question directly, but sometimes we won't. I mean, the times that we've asked that question, it's, well, all you need is that one piece of equipment. Why didn't you buy it? Well, I didn't want to take on the debt to do that. Well, why didn't you want to take on the debt? Oh, well, I just don't like having any debt, et cetera, et cetera. And I get it. We're all humans with different aspects of our personality, and some people are really fearful of this, some people are really fearful of that. But from our perspective is, to some degree, it's if you're so sure about that, strategy or new product line being successful, that all you needed to do was, take out a line to buy a piece of equipment, but you didn't have the confidence. Why should I have the confidence that's a sure path to doubling the business, increasing revenues by 20 or 30% or whatever? It's less about the actual situation, in this case, that the company doesn't have debt on the books, and more about, okay, why does the company not have debt? What would be different about the company or the size of the company or whatever if they had taken on debt to pursue growth or whatever? So, again, I'm not saying that these are, universal truths where you should always spend a ton of money or some money on sales and marketing, or you should always have a debt on the company, because if you don't, that means you haven't pursued all the growth that you could. However, the point is just that, but I do think in many situations that it would be. So my question for you is, I labeled these as unpopular opinions. I mean, do you think they should be unpopular? Do you agree with them, disagree with them, somewhere in the middle? I mean, let me know, because, I always want to think about ways to improve how I interact with business owners, how I think about the business, how I evaluate the business. And I would really appreciate feedback to just let me know if perhaps I should be thinking about these two areas differently.